For most of your working life, taxes probably felt fairly straightforward. Your employer handled deductions, taxes came off your paycheck automatically, your T4 arrived, you filed your return, and life moved on. But retirement changes more than just your schedule. It changes how income arrives, how taxes work, and who's responsible for keeping everything organized. And here's the interesting part. Most Canadians are never really taught what changes until now. Today, I want to walk you through 7 important tax and retirement planning shifts that happen when you retire. The kinds of things that can catch people off guard, but are actually very manageable once you know what to look out for. Hi, I'm Stefano Francesca, Certified Financial Planner Professional and Senior Wealth Advisor at Next Step Wealth Management with IPC Securities Corporation. And if retirement is on the horizon, or you've recently retired, my hope is that this video helps you feel more informed, more prepared, and more confident about what comes next. Remember to like and subscribe. It really helps more Canadians see this. Let's get into it. Number 1, your RSP eventually changes jobs. Here's one that sounds intimidating, but really doesn't need to be. By December 31st of the year you turn 71, your RSP needs to be converted either to a RRIF or an annuity. If you miss that deadline, your entire RSP is collapsed and every single dollar is added to your income for that tax year, all at once. Listen, every financial institution is watching this pivotal age and rule. They don't want that to happen to you, but you need to be aware of the rule and you need to proactively contact your advisor or your institution before it happens to you. Next, I want to clear up one big misunderstanding. The conversion itself from RSP to RRIF is not taxable. Think of it this way. Your RSP spent decades helping you build wealth. At age 71, it's forced to simply change jobs. Instead of helping you accumulate money, it starts helping you generate retirement income. Finally, many people think that they have to wait until age 71 for this job change to happen. That's just not the case. You can convert to a RRIF well ahead of age 71. And in many cases, it's advisable to create retirement income, to leak income at a low tax rate, to split income with your spouse beginning at age 65, whatever makes sense in your financial plan. That transition is usually very straightforward when handled ahead of time. The key is simply not leaving it until the last minute. We like to handle these types of transitions in the summer months, well ahead of the year-end deadline. A little planning goes a long way. Number 2, RRIF withdrawals can create surprise tax bills. Once your RRIF begins, there's a minimum amount you're required to withdraw each year. And here's the part many Canadians don't realize. On the minimum RRIF withdrawal, tax isn't withheld automatically. So the money arrives in your account looking like spendable income, but it's still taxable. I've seen this catch retirees off guard, especially in the first few years of retirement. Someone withdraws their income through the year, uses it for travel, home projects, helping family, all perfectly reasonable things. Then tax season arrives and they're wondering, why do I suddenly owe money? Usually the solution is very simple. You can ask your financial institution to withhold tax on RRIF withdrawals upfront. It's one of those small administrative decisions that can make retirement feel much more predictable and minimize those nasty tax surprises. Number 3, you may need to think about taxes differently. One of the biggest shifts in retirement is that income starts coming from different places. Instead of one employer paycheck, you may be receiving income from CPP, OAS, a pension, RRIF withdrawals, or investment income. And here's something many people are surprised to learn. Not all of those sources withhold tax in the same way. Sometimes too little tax is withheld, and that can create an unexpected balance owing at tax time. Sometimes too much tax is withheld, and that creates a cash flow problem. I often see retirees genuinely surprised by this in the first year or two. Everything feels fine during the year, income is coming in, retirement is underway, and then April arrives with a tax bill that they weren't expecting. In some situations, if enough tax is owing repeatedly, the CRA may ask you to pay taxes by installment throughout the year. If your net tax owing exceeds $3,000, $1,800 for Quebec residents, in the current year and in either of the 2 previous tax years, you can expect an installment request. Installment requests aren't inherently bad. They're just a request for projected taxes, which is fair. The issue is that if you miss those payments, you're technically in arrears of tax, and the CRA charges interest and potential penalties on what you owe. Paying interest and penalties in retirement is not on my retirement bucket list. The good news? This is usually easy to solve proactively. You can often request additional tax withholding directly from pension income, OAS, or RRIF withdrawals so things stay organized automatically. The way we do it is that we reference the tax plan within your retirement projection to see the anticipated total tax. Then we calculate and adjust all the withholdings so that they're in line. A small adjustment early on can make retirement feel a whole lot smoother. Number 4, the OAS clawback works on a delay for your monthly benefit. Many retirees have heard about the OAS recovery tax, often called the clawback. For 2026, if your income exceeds approximately $95,000, your OAS may begin to be reduced gradually. But the part many people don't realize is this: it works with a timing lag regarding your monthly benefit amount. In other words, your OAS beginning in July is based on last year's income. Why does that matter? Well, imagine someone sells a rental property, makes a larger RRSP withdrawal, or has an unusually high income year. The event is over. You filed your return. You paid the clawback. Life moves on. And then a few months later in July, OAS payments are unexpectedly lower. That timing catches people by surprise. The good news is this becomes much easier to manage when you plan ahead. If you know your income this year will be significantly lower than it was last year, there is a form, the T1213 OAS, that you can submit to Service Canada to request reduced withholding moving forward. Sometimes that works. Sometimes a simple conversation with your advisor around withdrawal timing can help reduce surprises and create a more tax-efficient retirement income strategy. Number 5, filing taxes still matters even with lower income. This one is especially important. For low-income retirees receiving the Guaranteed Income Supplement, filing a tax return every year is essential. Even if income is modest, even if there's little or no tax to pay. I've seen situations where one spouse always handled finances, and after a life transition, such as losing a partner, filing simply falls off the radar. Unfortunately, benefits can stop if Service Canada doesn't receive updated information. And often, people don't realize something changed until months later. The simple takeaway: even in retirement, with modest income, there's still a very good reason to file taxes every year. It helps keep important benefits flowing smoothly. Number 6, pension income splitting is one of retirement's most overlooked opportunities. If you're married or in a common law relationship, this one is worth paying attention to. Depending upon your situation, eligible pension income can often be split between spouses for tax purposes. And in many cases, that can create meaningful tax savings. What I like about this strategy is how simple it can be. No money physically moves between the spouses. You're simply reporting income differently on your tax returns. And for some couples, it can reduce the household tax bill by thousands of dollars over time. The surprising part? Many Canadians don't even realize this option exists. Even though this is a relatively simple election to make on a tax return, it requires planning and action to ensure it can work for you. You see, prior to age 65, RRIF withdrawals are not considered eligible pension income, but at 65 onwards, they are. As well, after 65, RRSP withdrawals are not considered eligible pension income. So don't get caught off guard here. If you're approaching retirement or recently retired and you want to make sure you're not missing these obligations or leaving money on the table, click the link in the description to book a consultation. We'll review your specific situation and make sure your retirement income is structured correctly from the start. Number 7, CRA and Service Canada are two different systems. I saved this one for last because it connects almost everything we've talked about. The CRA and Service Canada are separate organizations. And while that sounds simple, it causes more confusion than you'd think. The CRA handles things like taxes, TFSA contribution room, and tax correspondence. Service Canada handles CPP, OAS, GIS, and benefit payments. So if you move, change banking information, or update personal details in retirement, you'll often need to update both systems separately. I know that sounds a little bit administrative because it is, but it's one of those practical things that helps retirement run more smoothly and avoids unnecessary headaches later. Here's what I want you to take away from all of this. Retirement doesn't have to feel complicated, but it is different. The rules change, income changes, and there are a few moving pieces that most Canadians were simply never taught. The encouraging part is this: most of these issues are entirely manageable with a little planning and the right guidance. In fact, sometimes one good conversation can bring a tremendous amount of clarity and confidence to how everything fits together. If you're within 5 to 10 years of retirement or already retired and you'd like help making sure your income strategy, tax planning, investment process, and retirement structure are working well together, there's a link in the description to book a complimentary consultation. We'll We'll simply walk through your situation, answer your questions, and help you understand what opportunities or planning considerations may be worth paying attention to. Thanks for watching. Be sure to hit that like button. Let's take the next step.